Your wallet just got a tiny bit of breathing room. Or did it? The Federal Reserve just made a move that millions of Americans have been desperately waiting for. But here's the twist that might leave you scratching your head. On Wednesday, the Federal Reserve finally pulled the trigger on something they haven't done all year. They slashed interest rates. But here's where it gets controversial. This quarter-point decrease that everyone's been anticipating probably won't deliver the instant relief you're hoping for on that mortgage or auto loan you've been watching like a hawk. Let's break this down in plain English, because the Fed's decisions can feel like they're speaking in financial hieroglyphics. When the Federal Reserve cuts interest rates, they're essentially making it cheaper for banks to borrow money from each other. Think of it as the financial world's version of a discount sale, but one that doesn't immediately show up in your shopping cart. Now here's the part most people miss. There's a significant gap between what the Fed does and what you actually experience as a consumer. While the Fed controls something called the federal funds rate, the interest rate banks charge each other for overnight loans, your mortgage rate, car loan interest, and credit card APR are influenced by a complex web of factors that go far beyond this single decision. For beginners wondering why their loan rates haven't magically dropped overnight, here's the reality check. Mortgage rates are more closely tied to long-term bond yields, which are influenced by investor sentiment, inflation expectations, and global economic conditions. Auto loans and credit card rates do respond to Fed changes, but banks don't flip a switch and immediately pass savings to consumers. They often wait to see how the economic landscape unfolds. But here's where things get really interesting and potentially frustrating. This 0.25 percentage point cut represents the Fed's first rate reduction this year, signaling their belief that the economy needs some stimulus. Yet, many financial experts argue that in today's economic climate, such modest cuts are like bringing a water gun to a forest fire. And this is the part that might spark some heated debate. Are these incremental rate cuts actually helping average Americans? Or are they primarily benefiting Wall Street and large corporations? While banks and investment firms often see immediate benefits from lower rates, everyday consumers frequently find themselves still struggling with high borrowing costs months after Fed announcements. The timing of this move raises eyebrows too. With inflation concerns still lingering and housing affordability at crisis levels in many markets, some economists question whether the Fed is moving too conservatively, while others worry they might be moving too aggressively given persistent economic uncertainties. So what does this actually mean for your financial planning? If you're shopping for a home, don't hold your breath for dramatically lower mortgage rates tomorrow. If you're considering a car purchase, you might see some modest improvements in financing options over the coming months. But don't expect a revolution. Credit card holders might eventually see slightly lower minimum payments, but high balance debt will likely remain expensive to carry. Here's the controversial question that needs asking. In an era where many Americans are struggling with record-high housing costs, student loan debt, and credit card balances, are these traditional monetary policy tools even effective anymore? Or has the financial system evolved to the point where Fed rate cuts primarily benefit those who are already financially comfortable? What's your take on this? Do you think the Fed's rate cut will actually help ordinary Americans? Or is this another example of policies that sound good on paper but fail to deliver real-world relief? Have you noticed any immediate changes in the loan rates you're being offered? Share your thoughts, because this debate is far from over, and your experience matters more than any economic theory.